Welcome back to Everyday Economics, a podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, president of the 501c3 nonprofit Franklin News Foundation. Everyday Economics is a production of America's Talking Network. You can check out all of our great podcasts at americastalking.com. We are recording today's episode on Friday, April 21st, and joining me as always is my friend and colleague, Dr. Orphe Divounguy. Dr. O, could you please tell me why mortgage rates are moving up now? The Fed hasn't made a move, in how long has it been? A month? Mortgages are just creeping. I did a check yesterday. I was having a conversation with somebody about buying a house, and they were just asking me what I thought about the property, and I went and looked at the mortgage rate, and it was 7.09% here in Illinois for a conventional 30-year mortgage. What happened here? Wasn't it just like 6.2% and had been sinking like a rock? It's gone exactly the opposite direction. So what's driving that?
Yeah, no, absolutely. I get this question all the time. Why are mortgages moving up? And I think a lot of people have this misconception that the Fed is the driver. No, it's not the Fed that drives up mortgage rates. It's inflation. Simply put, mortgage rates have risen because inflation has risen far above the Fed's target, above a level that's consistent with sustainable economic growth. Let me just give you the intuition. When higher inflation cause rates across the board to increase, not just mortgage rates. And it starts with, like credit cards, your car loans. And that's because inflation erodes purchasing power, right? The Fed is only reacting to higher inflation. But the reality is that when lenders begin to suspect that inflation is going to be higher and that their purchasing power is going to fall, they will only lend so long as the return or interest rates on their loans will be high enough to offset any future decline in purchasing power. And so when people start to see inflation, when the market starts to see inflation creeping up, it gets worried. And what it does is you start to see mortgage rates, long-term yields, the yield on the 10-year treasury, and then mortgage rates that tend to follow those long-term yields also increase. And so what data did we get that may be suggestive of inflation remaining somewhat resilient? You just have to look at core CPI. Headline inflation has declined significantly in March. I think we were above 6% and we're down to 5% in March. But, core inflation, which strips out the prices of food and energy, remains high. It's still more than double the Federal Reserve's 2% target. And it actually went up. It's now, it went to annual core CPI is at 5.6% in March compared to 5.5% in February. And so that increase is why you see long-term yields creep up. The St. Louis Fed President James Bullard came out this week and said, he pointed at that. He also pointed at the tight labor market. The labor market remains extremely tight. And a tight labor market tends to mean wage growth is going to be higher than productivity growth, which means inflation might still be sticking around. And so Bullard was really quick to point out those factors. And the last thing he pointed to was the fact that the financial stress that we had seen due to the recent turmoil in the banking sector had also been somewhat abated, right? And that you start to see kind of financial stress conditions return to what they were before the banking sector turmoil, which, by the way, the Fed was hoping to kind of help do the job for it by cooling down the U.S. economy. That's not necessarily happening right now. And so all of these factors point to more resilient inflation, core inflation, and that's why mortgage rates have been swinging back up.
Let me throw a couple stats at you from Diana Olick at CNBC. She wrote about the drop in mortgage rates earlier this week in a story that carried the headline, "Mortgage demand from homebuyers drops 10% as interest rates jump." There were two CNBC, and I kind of like this journalistic technique where they pull the key points out so you can quick read it. One of them is, last week, I'm reading directly from this. Last week, the average contract interest rate for 30-year fixed rate mortgages with conforming loan balances, and these are under the jumbo limit of $726,200, increased to 6.43 from 6.30. they have in the last couple of days past that. They just continue to roll. But this is, I think, the more underlying issue. Applications to refinance a home loan decreased 6% from the previous weeks and were 56% lower than the same week a year ago. That refi market is just about toast right now. I mean, unless you are in a really weird spot with a weird financial product that you purchased a couple of years ago, there's no way in the world that you'd be needing to, or you'd be wanting to refi right now.
Yeah, nobody wants to trade a low mortgage rate for today's rate.
We looked at this a couple of weeks ago. We talked about this. Like, what is the difference between a 6.5% mortgage rate and a 3.5% mortgage rate? And it wound up being, on a $400,000 house, it was like $8,100 though.
Exactly. If you had bought a house for $500,000 last year at 3%, or in 2021 at 3%, you were looking at about a $2,300 monthly payment. At 6.5%, that same house will cost you $800 more a month. So your monthly payment will go up from about $2,300 to $3,100. So that's a big jump. And it's the same house, right? So it's not like you're getting more space or anything like that. And so a lot of home buyers are pulling back, but a lot of sellers who, by the way, we know 71% of sellers end up buying again. A lot of sellers are saying, hey, I'd rather stay in my house and maybe even do a little bit of renovations rather than go out and try to get a new mortgage. Trade my 3%, 3.5% mortgage rate for a 6.5% rate. So we see that in the housing market, sellers are pulling back, and that's causing actually the housing market conditions to remain very tight, which is why we don't see a big price crash in the housing market right now. But I think before we go, I want to give some advice for our listeners, because a lot of people always ask me, like, rates are going up, rates are going down, rates are going back up. Should I be waiting for rates to be lower before buying? I get this question a lot. And here's my advice to people. You cannot predict where mortgage rates are going. You cannot, and nor should you, ever try to time the market. We hear this all the time when it comes to stock advice, and we don't hear it enough when it comes to home buying. And I'm here to tell you should not be trying to time the market. It's not going to work. Historically, mortgage rates have hovered around 7%. So this is actually the norm, not the exception. The 4% mortgage rate, the 3% mortgage rate was the exception. My advice to people is, if you really, really love a home and it's going to be your forever home, or you're going to live in it for the next 10 years or so, do not sit there and look at the mortgage rate as the all and be all of your decision. It's not. It doesn't. Look, the fact is, you'll probably never get a time where rates are falling and prices are also falling at the same time, because there's so many buyers waiting on the sidelines. When rates fall, home buying demand goes up. That puts upward pressure on prices. And so, you're not going to be able to catch that moment where rates have fallen and prices are also falling at the same time. It's going to be very difficult. It's probably impossible. With single family housing starts falling for much of last year, it's likely we're going to continue to have a single family housing unit deficit across most of the country. And that means single family homes aren't likely to get any cheaper. And the last thing I'm going to say is look at what your parents paid for their home, or your grandparents, and look where house prices are today. Delaying the decision to buy a home just because of mortgage rates may not be the wisest decision. Now, we are in a slowing economy, although I think the labor market's still pretty strong. The one thing I would say is worry more about your ability to make your monthly payments on time. Don't worry so much about the mortgage rate, because you could always refinance that rate later, right? If mortgage rates do end up declining, you'll be able to refinance, and that will not be a problem. You'll be able to lower your monthly payment, et cetera, et cetera. I don't think people should be in the business of trying to time the market, or, let's wait for mortgage rates to decline. I think no, it's not going to happen. You're not going to be able to successfully do it. And even for the best of us, it's very difficult to figure out where mortgage rates are going next.
Appreciate your thoughts as always. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other quality podcasts at americastalking.com.